Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the first quarter of 2019. During the first quarter of this year, Facebook was charged with high-tech housing bias. The world's biggest banks were accused of price fixing Fannie Mae and Freddie Mac bonds. The bond yield curve inverted for the first time since 2007, and a change in the monetary policy at the Federal Reserve as part of its Federal Open Market Committee operations were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the first quarter of 2019. During the first quarter of this year, the U.S. Department of Housing and Urban Development charged Facebook with high-tech housing discrimination for allegedly allowing landlords and real estate brokers to systematically exclude certain groups of people from seeing ads for houses and apartments. The lawsuit alleges that Facebook discriminates against people based upon who they are and where they live. HUD accused Facebook of allowing advertisers to practice a sort of high-tech form of redlining by excluding people in entire neighborhoods or zip codes from seeing their ads. HUD also accused Facebook of giving advertisers the option of showing ads only to men or women, excluding parents, those who are non-American born and non-Christians, excluding those interested in Hispanic culture, deaf culture, or accessibility for the disabled, excluding those interested in countries like Honduras or Somalia, and excluding those interested in a variety of other topics. According to representatives at Facebook, the company is working in conjunction with HUD on a process to resolve these problems. Going forward, prospective homebuyers should keep in mind the potential for being adversely affected by similar high-tech housing discrimination practices when reviewing information on other housing websites. Prospective homebuyers can use the housing resources found in the Housing News section on the Adkins Capital Management website in order to help them make a prudent home purchase decision. According to a class action lawsuit filed by the state of Pennsylvania, more than a dozen of the world's largest financial institutions conspired to fix the prices on more than $485 billion in bonds issued by Fannie Mae and Freddie Mac over a 5-year period. The lawsuit alleges that Bank of America, Barclays Capital, BNP Paribas, Citigroup, Credit Suisse, Deutsche Bank Securities, First Tennessee Bank, FTN Financial Securities, Goldman Sachs, JP Morgan, JP Morgan Securities, Merrill Lynch, and UBS Securities conspire to both overcharge and underpay investors on debt bonds issued by Fannie Mae and Freddie Mac between 2009 and 2014. The bonds in question were issued by the government-sponsored enterprises in order to support their operations and were not mortgage-backed securities. The bonds are traded in the over-the-counter market, which means that investors work with the bond trading desks at the named institutions to buy and sell the bonds. The lawsuit claims that the named institutions conspired to fix the prices on those bonds, which allowed them to underpay sellers and overcharge buyers. According to the lawsuit, the named financial institutions controlled more than 64% of the total underwriting of Fannie Mae and Freddie Mac bonds during the time in question, with each financial institution underwriting at least $28 billion in bonds. Prospective homebuyers that are concerned about this issue should obtain a mortgage loan from a lending institution that does not sell mortgage loans to government-sponsored enterprises after they have been underwritten. The implications of an inverted bond yield curve on housing is another topic that is worthy of discussion. Economists use the bond yield curve to measure the relationship between Treasury bills, notes, and bonds in order to assess the state of the nation's housing and to help measure the economic sentiment in the U.S. economy. The yield curve is simply a plot of bond yields for short-term, moderate-term, and long-term securities in chart format over time. Normally, the yield curve is upward sloping because people typically perceive more risk in holding longer rather than shorter-term bonds. Accordingly, investors require a higher rate of return for tying up their money for a longer period of time, hence an upward sloping yield curve. Paradoxically, during the month of March, the yield curve inverted at a level around 2.46%. This is the first time that a yield curve inversion has happened since 2007. When the spread between the short and long-term rates narrows, it's a signal that people are less certain about the future growth in the economy. An inverted yield curve is considered a predictor of a future economic recession. According to Reuters, the U.S. Treasury yield curve has inverted before each recession in the past 50 years and has only offered a false signal one time during that period. The implications of an inverted yield curve on the housing market are mixed. On the positive side of the spectrum, given the recent monetary policy guidance provided by the Federal Reserve Chairman and the actions of the Federal Reserve, borrowing costs for mortgage loans should remain attractively low, which in turn means that purchasing a home will still be very affordable when analyzed from a historical perspective. On the negative side of the spectrum, the rising short-term Treasury yields, which have led to an inverted yield curve, implies that the economy will be slowing, wage increases will likely stall, and unemployment will most likely rise. This in turn will likely place more uncertainty in the minds of prospective homebuyers and whether or not they want to take the financial risk that is associated with owning a home. Overall, prospective homebuyers that have jobs that are unaffected by market conditions and the state of the economy, such as teachers and government employees, may find many attractive home purchase opportunities in the future. However, if a slowing economy does come to fruition, it will likely foster an uncertain working environment. This in turn will likely cause prospective homebuyers to be cautious about purchasing a home, thus exacerbating a decrease in housing sales and a cooling off of the housing market. With this in mind, prospective homebuyers should have ample time to decide on whether or not they want to purchase a home. Moving away from these policy issues and events and to an assessment of the mortgage lending environment, it is important to note that for the first quarter of 2019, the national average mortgage loan interest rate for a 30-year fully amortized fixed rate loan began the quarter at 4.84% and ended the quarter at 4.11%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to keep the range for the target federal funds rate at 2.25% and 2.5% during their Q1 2019 Federal Open Market Committee Operations meeting. Ironically, the Federal Reserve's position to hold the target federal funds rate steady is a change in the Federal Reserve's monetary policy position, as the Fed raised the key target range interest rate level every quarter in 2018. Prospective homebuyers should remember that a mortgage loan interest rate of 5.3040399% for a 30-year fixed rate loan would require the homeowner to repay twice the home purchase price if the loan is repaid on schedule and held until maturity. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Now that I have provided an overview of how the Adkins Residential Home Valuation Analyzer is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the first quarter of 2019, 27 cities that make up the Adkins 60 City Home Price Index were classified as overpriced. Newark, Los Angeles, San Francisco, Honolulu, and Miami were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 4.11% to 0%. In order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amount. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $62,395 and $222,285. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $150,180 and $501,248. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, 33 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the quarter. Oklahoma City was classified as the most underpriced city in the index, and Wichita was classified as the second most underpriced city in the index. While Charlotte, Anchorage, and Little Rock were classified as the third, fourth, and fifth most underpriced cities in the index, based upon their justified percentage of household income amount, Charlotte was classified as the third most underpriced city, based upon its higher justified mortgage loan interest rate amount. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 4.11% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the costs of a mortgage loan. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing of homes in their community. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.